GDP numbers.
That Australia continues to successfully manage the transition from the largest resources investment boom in our history to broader-based growth and in turn secure Australia's economic future. In the face of global uncertainty and strong headwinds, our economy continues to transition and grow. Real GDP grew by 0.6% in the December quarter and by a strong 3% compared to a year ago, up from a revised 2.7% through the year to September. This is the strongest pace of through-the-year growth since the March quarter of 2014, just prior to the 14-15 budget, and is consistent with the strength of job creation in the second half of last year. We are growing faster than every economy in the G7 and growing well above the OECD average. We're growing faster than the United States and the United Kingdom, and more than twice the pace of comparable resource-based economies like Canada. And we are matching the growth rates in economies like South Korea. The key drivers of economic growth, as shown in the December quarter figures, were household consumption, new housing construction, services exports and public investment, more than offsetting continued and expected declines in resources investment. The changing composition of our drivers of growth demonstrates the transition to broader-based growth that is underway in our economy and the increases in both consumer confidence and improving business conditions. Strong employment growth continues to support solid growth in household consumption, which rose by 0.8% in the December quarter. Construction of new dwellings increased 3.6%, particularly in apartments where investors are more prevalent, and by 12.1% over the past year, responding to record low rates. The combined effect of recent changes by APRA that have led to a tightening of investor lending criteria, together with strong growth in housing supply and a considerable pipeline of work underway, has helped to moderate growth in dwelling prices over recent months and is welcome. This is good news for first home buyers. While having no impact on the December quarter growth figures, net exports, though, have contributed 1 percentage point to growth through the year to December, as exports growth has outpaced imports growth. This follows the strong contribution of net exports to economic growth in the September quarter figures. Exports continue to grow in the December quarter, rising 0.6%. Looking through quarterly volatility, the growth in exports is broadly based and welcome. Rural commodity exports have risen by around 13% over the past year, and mining exports have risen by about 5% compared to a year ago as resource investment projects reach completion. Service exports have risen by 8% over the past year, with sectors like tourism and education being particularly strong performers. Business investment continued to detract from growth in the December quarter. This is expected, falling by 2.7% to be 12% lower than a year ago. Now, this is driven by the expected decline as Australia transitions from the investment phase of the mining boom, so no surprises there. The terms of trade result was once again negative, impacted by further falls in commodity prices during the quarter, which reduces what we earn from our exports. The terms of trade is now closing in on the 20-year average, after falling more than a third since its peak in the September quarter of 2011. Wage income shows modest growth, which has supported the strong employment growth outcomes we saw over the year, with more than 300,000 jobs created last year. While profits growth improved in the December quarter after a period of weakness, like wages, it still remains well below longer-term trends. Government revenues will also continue to be impacted by more modest growth in nominal GDP, rising by a subdued 0.4% in the December quarter, weighed down by both commodity price falls and continued moderate inflation. Lower levels of nominal GDP growth means lower growth in what Australians are earning, which means lower revenues for governments. In MyEFO, there was a substantial write-down, and in fact it was the principal write-down of revenues from the last budget as a result of revised forecasts for nominal GDP growth. Now, this will remain a key conditioning factor as we frame the 2016-17 budget, and is one of the major challenges for achieving our immediate-term fiscal consolidation strategy. As I said the other week, this will take budgets and budgets and budgets. Year average nominal GDP growth last year was just 1.9%. Now, during previous periods of fiscal consolidation, where budgets were being returned to surplus, nominal GDP growth in those particular periods averaged 5.7% in the 1990s and 11.4% in the 1980s. Now, while these periods also involved very significant expenditure restraint, which continues to be absolutely necessary and my primary focus as we prepare the budget, the tailwinds of stronger nominal GDP growth during those periods, boosting revenues, made a significant contribution to the fiscal consolidation outcomes that were achieved at that time. It did provide some rather helpful tailwinds. With solid consumption, we wouldn't mind the same breeze. With solid consumption demand and robust employment growth, the next phase of Australia's transition will be for businesses in the non-resources sectors of the economy to increase their investment. Conditions are in place for this to occur. Interest rates are low. The dollar, as the Governor likes to say, and rightly, is doing its job and has depreciated over the past few years, assisting our export and import competing industries, and business conditions in the non-mining sector are above average. As a government, it requires us to continue to keenly focus on the policies that will boost investor and consumer confidence, that will drive productivity gains in our economy, particularly through our very keen focus on innovation, and to continue to open up new markets through our successful and ambitious trade agenda, and continue on our path of fiscal consolidation. Tax and spend is not a plan that will support the continued successful transition of our economy. Tax and spend is not a plan that will boost investor confidence. Tax and spend is not a plan for jobs and growth, but it is the plan being followed by our opponents. Our transitioning economy is aligned with the transitioning economies of our trading partners, in particular China. As they are moving from a production to consumption-based economy, we are moving to a diversified, more sophisticated economy with innovation and services driving sustainable and growing trade and incomes. Today's data shows again further strong signs of the successful transition that is being made in our economy and that is creating a new and emerging momentum for that economy in our future. Thank you. Happy to take questions.
Treasurer, you talked about the not having the tailwind of higher GDP.
Nominal GDP,
Nominal
yeah.
GDP.
GDP, real GDP, as I've said, is very strong. Strong, I should say. Yeah.
One of the objectives of tax reform is to get a growth dividend, but of course you've scaled back those tax reform ambitions in recent weeks. Are you still confident that you can get a growth dividend from the tax reform agenda? And what do you say to people who sense a drift in the government's intentions at the moment on tax reform?
Well, tax is part of a broader range of policies which the government is pursuing. I mean, I've talked about the innovation agenda. I've talked about, in the past, the infrastructure agenda. We've talked about many other areas of improving productivity right across the economy, and this is important. Tax is obviously part of that. But as I've said on other occasions, the scope for what can be done in tax, because of the environment in which we're in, is quite conditioned. I mean, if you want to change tax rates, and particularly reduce tax rates, then that's traditionally funded out of a surplus. Well, the Labor Party didn't leave us one. We left them one. They certainly didn't leave us one. You can fund it out of good, strong nominal GDP growth, as I was mentioning before, where there was nominal GDP growth during other periods of fiscal consolidation and over 5%, and indeed in one period over 11%. That's not our outlook. And so you're reduced to a very constrained series of options. And as you know, we looked at some of these, and we looked at the tax mix switch idea, and because of the significant costs of compensation that would be necessary, which could add as much as 1% of GDP to outlays. Now, at a time when you're trying to fiscally consolidate, adding 1% of GDP to outlays to achieve that would have been very significant for the budget and would also overwhelm the gains that would be achieved economically. So you've got to deal with the situation you're in, and that has moderated the series of options we have available to us in this area. But the broader principle is this: you don't tax higher to spend higher. And that's what we're not going to do. You don't tax high to spend high. That's what our opponents want to do. We will seek to alleviate the tax burden for both individuals and companies wherever we can within the conditions that we find ourselves in, but not at the expense of the real task we have around fiscal consolidation, nor at the expense of loading up the tax burden on other Australians.
Treasurer, you've talked extensively about bracket creep and the impact that's having on people. What do you think is a reasonable tax cut for someone who might be being pushed into the 37% tax rate?
Well, I have been concerned for some time about the fact that we're going to see hundreds of thousands of Australians move into higher tax brackets, and that's been occurring now for some time. And that will continue to occur. That will continue to occur unless there are changes that will be able to be made, but those changes have to be funded. And if you're, as we are certainly doing, as we continue to seek to control new expenditure and address current expenditure levels, then those gains need to be put to the medium-term fiscal strategy. They need to be put towards ensuring that we're reducing the deficit. And that's why our discussions and analysis around tax has been very much around the mix of taxes and to see how those mix of taxes can be improved to provide the sort of relief that you're referring to. So that process is not yet complete. The budget, surprisingly, is still in May. That hasn't changed. It's not going to change. It will be in May, and the full details of what the government plans in those areas will be the back marker for that to be announced.
Do you think people looking forward to, say, a $10 a week tax cut or $20 tax cut? What sort of a tax cut would a person say, this is a real tax cut?
The real challenge here is it's a prospective challenge. It's a prospective challenge. And what you want to have happen in your economy is for people who are out there having a go and working and saving and investing, you want them to be able to get more from what they're putting in, whether it's a company or whether it's an individual or a small business, an innovator. And that's why we put the tax incentives in around small business and innovation, to ensure that they can get a better dividend about what they're putting in. Because the great news of this story that we're talking about today in the December quarter national accounts is that the transition is occurring. It's not a promise, it's happening. And it's not only us who've recognised it. When I met with Minister Lo Jiwei on the weekend, the Chinese government have acknowledged of what is happening in our economy, and we're impressed by it. Many other commodity-based economies are nowhere near the performance we're achieving. So, look, we want to ensure that there is the reward for people putting in that extra effort, but that is obviously constrained by the fiscal environment in which we work.
Treasurer, you say that it's a prospective challenge, and you have said previously that changes will have to be phased in, and you're talking about the future. Are you suggesting that such changes, such tax relief, such changes to the tax mix will occur down the track beyond the next election?
Well, what I'm suggesting, Dennis, is that any changes that we're making will be announced in the budget. Today I'm talking about the December quarter national accounts. But you're very welcome to come to the press conference we hold after the budget and ask these same questions.
Treasurer, what did you make of Tony Abbott's contribution to the debate?
Have we got questions on the December quarter national accounts? Perhaps there's some economists in the crowd.
Treasurer, you make the point that we're doing better than the G7. You might also make a point that they also have very weak nominal growth issues, maybe not as much as us, but they do. Yet their fiscal consolidation is quicker than ours, according to the OECD.
Well, they're working also from a far worse position. I mean, take the UK, for example. Their size of government as a share of the economy is still larger than ours. And so they have had to travel a lot further than Australia has had to. I mean, it is quite striking when you have the opportunity to go and discuss these matters with your colleagues, when there are some economies that have rates of debt to GDP, 3 times ours, and saying they have room, they have fiscal room. We don't share that view, because we judge our conditions based on our standards. And the coalition standards is that obviously we don't want to see debt where it is. The coalition standards are we don't want to see the deficit remain where it is. By continuing to apply our standards to how we manage our economy rather than the standards of others, that I think is one of the ways why we'll continue to be successful with our policy settings. Phil?
With tax reform, proposals doing the GDP.
If you're on National Council, I'll go.
It's following on from Jacob's point, but with weak nominal growth, do you still expect to be able to achieve reduced government spending as a share of GDP, across the years ahead?
Well, this remains our objective, and it must be. It must be. The MyEFO estimates and projections, as you know, had government spending as of the share of the economy falling to 25.3% over the budget and forward estimates, down from 25.9%. And that remains, the track we're on, and that still has us above the long-run average. I mean, revenue as a share of GDP on the MyEFO estimates crosses the line of the long-run average next year. But expenditure as a share of the economy doesn't get to that level over the budget and forward estimates. And so revenue as a share of the economy will continue to rise beyond the budget and forward estimates, and there are some projections which put that up as high as 25.8%. Now, so those revenues lift. Being able to forecast those revenues in the sort of unpredictability of the volatility of what we've seen with prices and things like that has been a difficult challenge for some years now. We all know that. And that impacts on the parameter estimates for your budget. And that will continue to be an issue over the next few months as we seek to lock in what they will be for the budget. What I'm talking about on nominal GDP is this. In MyEFO, we made a considered decision to revise those forecasts and projections around growth. And I think that was a very realistic assessment of the situation at that point in time. We were seeking to be very candid with the Australian people. There was no suggestion from anyone or in the commentary that there was any blue skying of the out-year forecast, which has been a trick of the previous government. That's not something I'm seeking to engage in. I'm looking to be really honest with the Australian people and say there is global uncertainty, there is global volatility. Our growth performance at a 3% through the year in these figures is very encouraging and should be a pat on the back for every Australian who's been out there making this transition of our economy work. But for it to continue, we need to continue to go down the path of fiscal consolidation. We need to continue to go down the path of productivity improvements. We need to continue to go down the path of supporting investor confidence. And I'll tell you one thing you don't do if you want to support investor confidence is you don't jack up the GST, the CGT on investment, which is what those opposites seek to do by 50%. Paul.
Just on this point about fiscal consolidation, you're stressing all the time that you'll be reviewing new spending, that there'll be restraint in relation to new spending. But what about existing spending?
Well, I've never put it as a binary proposition, Paul.
But you've stressed it pretty heavily.
Well, no,
and so
Paul,
given all the constraints on the government, surely the government should be more robust at looking at...
No, Paul, this is a myth. What you're putting to me is a complete myth. I've been consistent in saying that we need to get government expenditure under control, and that applies to the base as well as new expenditure. And that was demonstrated in the announcements that we made in MyEFO. So that's my practice. That's my record. It was my record also as a social services minister, where I introduced some of the bigger social welfare reforms that form part of the last budget. So I'm no stranger to having to deal with the expenditure challenge. And I'm no stranger to actually seeing those things pass through the parliament either. One of the few measures where we had those sorts of success when I was social services minister. So I understand the challenge of getting expenditure under control and have the record of having delivered on it. I will keep doing that, but the point I was making a week or so ago is that yes, we have made savings in the budget, but we've also spent a lot as well. Now, thankfully, we haven't spent more than we've saved. If it would have been the other mob, well, they would have spent it all and saved nothing. How do I know that? Because when I look at their current plans, that's exactly what they are. Spend a lot more, save nothing. And so that's why we will continue down that path, Paul. That's our record. It is both things, and we're going through that budget process now, and we will continue to keep a close eye on every dollar of expenditure, because every dollar of expenditure has to carry its own weight. Every element of the tax system has to carry its own weight. My point about that is it has to be fit for purpose and it has to do its job, because when you're dealing with a global economy like this and you're dealing with a nominal growth scenario like this, it all has to add up and it all has to drive to the point of the objective it's seeking to achieve.
Treasurer, do you still believe there are excesses in the current negative gearing arrangements?
My comments on that relate to the distribution of how people engage in it. Now, you could call them enthusiasms, you could call them whatever you like, but there's no doubt that there is a distribution about how people engage with negative gearing, and there's nothing wrong with that. I mean, that is part of the tax system. It is entirely legitimate practice to offset the cost of earning an income against that income. You then have to ask yourself the question about what broader impact that distribution of how people engage with those practices impacts on the broader economy, and whether there is any justification for making any changes on that. And that's what the government has been working through. In September of last year, the Prime Minister put negative gearing and all of these other issues back on the table. And so we've been going through a very deliberative process of working through those issues and to determine, well, what would be the impact if you were to make changes in any of these areas. And so that's why we haven't made an announcement on these issues, because we are going through the considered process. Now, our opponents failed to do that. They've put forward a policy where they're going to take 1 in 3 purchases out of the existing property market. 1 in 3. And they think that will have no impact. They think that negative gearers, those on high incomes driving around in flash cars, doing drive-by auction bids all around the country. But it's not. It's nurses, it's teachers, it's policemen, it's emergency services workers, it's paramedics. You know, that's who negative gears. And that's who we back. When I say I want to back Australians in, these are the Australians I'm talking about. It's mums and dads who are investing. It's people running businesses. It's people making big decisions in companies out there that are going to employ more people. That's what we're focused on. So we'll do the homework. We'll do the homework and then we'll make an announcement. Those opposite will just speculate something and cross their fingers and hope it works. That's no way to manage a transitioning economy, and that's why they can't be trusted.
Talk about this. Where are the excesses, though? That's what you're asked about.
Well, I think I've answered the question, Peter. What I'm saying there is...
You said where they're not.
I mean, calm down. There's a distribution of people that involve themselves in negative gearing. Some, the vast majority, 70% of those involved in negative gearing, sorry, 2/3, have a taxable income of $80,000 or less, and 70% of them only have one property and have a net rental loss of less than $10,000. Now, if you go to the other end of people who have net rental losses of over $50,000, there's about 1.6% of those who engage in negative gearing. Now, that's just a simple statement of the distribution of who engages in negative gearing. And obviously, those who are more engaged in negative gearing have higher incomes than those who are on modest incomes. Now, it's an entirely legitimate practice, and the question the government works through, unlike what our opponents have done, is, well, if you were to make any changes in that area, what would be the impact on the property market? What would be the impact on people out there engaging in buying houses and things like this every day? And so that's what we're doing the work on, Peter. So that's why we haven't sort of rushed out there. We don't feel the need to respond to everything Chris Bowen or Bill Shorten does. The Australian people don't either, I don't think. I mean, they can say whatever they like, they can put whatever crazy idea out they like, but the government will do things in a measured and considered way. Because remember this, what they're proposing is when you, under their plan, when you put the key in the door of the new property you buy, it turns into an old property. And at least 1 in 3 prospective purchasers of that property you bought have walked away. It's like driving a new car off the lot. That's what the impact is of what Labor is proposing. Now, they're free to propose it, but they clearly haven't thought through the consequences.
Have you looked at capital?
Sorry, going back. I'll do you both and then you keep everybody happy.
You told Dennis in his first, when he asked his question, that wait for the budget for the tax policy. Is that consistent with...
That's the back marker, yeah.
The back market, but that doesn't, you're not precluding a pre-budget release of the tax policy as the Prime Minister was alluding to on the weekend?
Well, the government has all options available to it, and I've said that's the back marker, and I think that's what people can expect, yeah. Dennis?
Treasurer, you mentioned the 50,000. Have you looked at caps below 50,000, perhaps as low as 25 or 20?
Well, I haven't suggested we're looking at caps at the other, Dennis. That's what you've suggested. So, I'm not going to agree with the premise of your question. All I've simply said is we've looked at the distribution of those who are engaged, and they're commonplace facts. I mean, you can look them up yourself and work this out for yourself, and you can work that through. And the government is just working through a very orderly process on this. We're not going to rush it just because Bill Shorten's impatient. He can wait. The Australian people know that we're going through a considered process, and we will come to an answer that is in the best interests of the Australian economy and Australians. And why is that so important? It's so important because they're the ones who are producing the figures that I've talked about today. They are the ones who are making this transition in our economy work. And our job is to back them in with good decisions that support them in their efforts. And that's what will always be the focus of economic policy under this government. Thank you very much.